Hello, I'm going to be talking about the March-June 2021 ACCA Strategic Business Reporting Exam. And before you listen to the debrief, it's important that you've downloaded the exam and had a look at it. In fact, I would strongly recommend that you have a go at each question or each part of a question, make some notes for yourself, and then listen to the debrief. So download the exam first, just to make sure you've got easy access to the data, and then we'll start to work our way through. You'll also need a calculator. So we're going to take a look now at question 1, which was called Columbia. Remember, before you listen to each stage of the recording, it would make sense to read that part of the question carefully and then have a go, just make some points, do any relevant obvious numbers before you listen to my debrief. This is the consolidation question, so-called. So part of the marks will be for some consolidation techniques. And probably it makes sense to sort out a little bit of a group structure before you get too far with this one. So in my group structure, I'm more worried about who owns who, but we are this company called Columbia. So that is us. And then Columbia owns or has some shares in a company called Peru, and another company also has some shares in Peru. The name of that company is Brazil. It's very easy, isn't it, to start thinking about the wrong company, but that is firmly us. Think about the shares a bit later, but the other thing you need to be very clear about is the year end. So the year end in this scenario is the year ended 31st of December X5. Just so we don't start going off on the wrong tangent. If you haven't already, pause the recording before you listen to what I say about part A. So part A, the very first part of this question, asked us whether Columbia should be considered the acquirer. So Columbia, I'm just saying there, acquirer, question mark. This was worth 9 marks. I think some students, when they see 9 marks, say they must therefore make 9 excellent points. Well, that would be lovely, but you'd also be the first person in the life of mankind who's ever done that. So don't start stressing like that. Put down any relevant knowledge and then start to apply it to the scenario. So you read through this scenario and we noticed that we own 50% of the shares and another company owns another 50%. Acquirer would imply, wouldn't it, that it's a subsidiary, or might be a subsidiary, or it could be an associate, or it could be a joint venture. But the word acquirer, I think, is the examiner saying, well, is this actually a subsidiary? On the face of it, if you just look at the shareholding, 50% doesn't give you control, does it? 51% is what gives you control. But you need to say, well, what knowledge is the examiner asking for? And then I'll start to worry about applying it to the scenario. So you don't need to write a subheading knowledge and a subheading application. You don't need to do that, but sometimes, at least in your mind, it helps. So no need to actually type this in the exam, the word knowledge. But you certainly need to demonstrate the knowledge. So the first thing is, we know that it could be conceptually a subsidiary? If it is a subsidiary, that requires control. And if you're going to turn up at the exam saying control means more than 50% of the shares, you're not doing this exam, you're doing the exam below. So you do need the definition of control. The definition of control now, as I'm sure you know or will do when you've revised, is that you have power over the investee and you are exposed to variable returns. What does that mean? It means you've got equity shares effectively. And finally, you have the ability to use the power to affect your returns. So that's subsidiary, isn't it? Then don't say, well, I think it is or it isn't yet. Set down all the relevant knowledge first. So the second possibility is that this company is an associate. If it's an associate, that would therefore imply significant influence. Now, significant influence probably doesn't need much more application than that. It's just mentioning the word. And finally, if it is a joint venture, which it could conceptually be, I suppose, that is again linked, isn't it, to the words joint control. And joint control means that each party or each investor has the right of veto. So like a couple, shall we go to the cinema tonight or shall we go to the theatre? Each of the couple can actually say, well, no, I don't want to go to the theatre. And again, so each one has the right of veto. So put down the knowledge first. Would the examiner be impressed if you quoted standard numbers? No, so don't. There are no marks for standard numbers. And there's a very high chance you'll quote the wrong number and we'll all end up confused. Now I can start to apply it to the scenario. And the point is, isn't it, that if you apply it wrongly, but you've put the wrong knowledge, the right knowledge down, then actually it's fine, you'll get through. Looking at this one, I think it's smacking of control. And again, we can see that there are many factors there that suggest there is control. So I'm just saying, and use as many as you can from the scenario, that control is evidenced or present. Why? Because you can appoint 60% of the board. So if you think about that for a minute, members, if there were 10 board members and you've got 6 and there's any majority vote, you're always going to win. You could also see that our senior manager, again, who's on the board again, basically has all sorts of key decision again. So there's control again in terms of decision making. And several factors are listed. But as an example again, decision making again over things like the revenue streams, decision making over financing. In addition, quite a tricky point, but if you think about it, when we bought this company, we paid more than the other one. You see, we paid with some money and some shares. The other one only paid with money, so we were paying extra for our share. Remember that if you pay extra, it's known as control premium. because it gives you the right to be in the driver's seat of running that business. So the other point that's probably worth appreciating is that we have paid a control premium. Why? Because we've paid in shares as well as cash. The other party, really, if you look at it, they do have the right of veto, but again, the right of veto of the other party is things like who will be the auditor. I mean, big deal. That's not going to make much difference, is it? And again, there's a right of veto over changes to the articles. You might remember the articles are things that you met when you did your law, probably ages ago. The constitution of the company, it's odd things like meeting notices and so on. It doesn't make a huge amount of difference. But in terms of who's really in charge there, surely it is us that is in charge. And you'll notice again that if you look at the words in the scenario, in the model answer, what they will say is that we have substantive rights. What does substantive rights mean? It means that in substance, we are in control. That's all. In substance, again, we are in control. So finally I can send, can't I? I can say, therefore, that we are the acquirer. There we go. There's the first part of question 1. So again, if need be, pause the recording and now have a look at the second part of question 1, and then we'll have a talk about the goodwill. Requirement B, lovely. We all like goodwill, don't we? Does it come up every time? Yes, it has to, doesn't it? Because goodwill is really, well, the most important thing about group accounts. And what we're looking at, isn't it, is we're looking for a calculation and an explanation. Which order you do it in doesn't really matter. On goodwill, because people generally feel confident about the performer, I'd probably set the calculation up first in your spreadsheet, and then you can just fill it in, can't you, as you work our way through the points. And as we work our way through the points, the important thing then is to explain everything quite carefully. So I would, like you, I think, set up my calculation first. This was for 11 marks, which to me feels a tad generous, but we're not going to complain about that, are we? It's nice. But most of the marks, or a substantial amount of them, would end up again for the actual explanation alongside the associated workings. So I'm going to use $1 million in my working. I would usually use 2 columns. And again, if I just set myself up first, I've got my consideration, what I paid, miss a couple of lines. Then I've got my NCI. And then from that total, I will then deduct my net assets at the date of acquisition. And you know the sort of performer. You would tend to put the draft net assets first and then sort out the adjustments against them. And then that would take us down, wouldn't it, to working out the final figure for goodwill. At the same time, we also need to make a start on our explanation. So, couple of foundation things I would always start with. We can come back to the calculation in just a moment. The first is, you'll always explain that goodwill is calculated by doing a comparison of fair values. So, it's the fact, isn't it, that in calculating goodwill, we need to think about the fair value. Now, I would write fair value properly. I've just abbreviated it here on the screen. The fair value of the consideration and the fair value of the net assets acquired. That's your basics, isn't it, from IFRS 3. And then, very importantly, you must explain what fair value means. The definition is in IFRS 13. You must know it. In this exam, I think it comes in a couple of times. So, fair value, keywords are, aren't they? The price that would be paid. So these are some of the words out of that definition. In an orderly transaction, again, to either, so it could be if you were selling the asset, or if it was a liability, transfer the liability. And you might as well say as well, it's a transaction, isn't it, between market participants and also that everything must be, of course, at the measurement date. In this case, the measurement date is the date of the takeover, when we acquire that company. So we can now start to work our way down the calculation. The first thing is the consideration that we've paid. The consideration that we've paid is partly in the form of cash and partly in the form of shares. In terms of the cash that we pay, let's have a look here. I think it's 50% of 5 times $8. And that would give me 2.5. That would give me 20 million, wouldn't it? Shares, 50% of 5, that's what we're buying. We're giving 1 for 20. The market price of our shares, $10, which extends to 1.25. Is there anything worth commenting on? Yes, the fair value of the shares. Notice that we are actually, of course, using the share price of the acquiring company at the date of the takeover, which lines up with what we've been saying about fair value. So let's make a note of that. So I'm just saying the share consideration, or if you prefer, the equity consideration, we use the share price of the acquiring company at the date of the transaction. So, or at the date of the acquisition. With shares, when you issue shares, there are no exceptions to that ever. It's always the share price on the date of the acquisition. After that, we've then got our NCI. And towards the end of the scenario, it says that our NCI is to be measured at fair value. Now, I own 50%, which means the other party owns 50% of 5. This time, I want the fair value of the subsidiary shares, and the fair value of the subsidiary shares at the moment again is $8. So that's another 20 that's being added across as the NCI. I'd probably make a note about that because it's quite, I'm not sure if you use the word interesting, but it must be mark-worthy. So again, I'm saying NCI, I'm using the share price of the subsidiary at the acquisition date. Nothing else we could use, is there, to try and get to a fair value for that? Then we get into the net assets, and we start out, don't we, with the draft net assets. The draft net assets were given in the question as 32. And then in the subsequent 3 paragraphs, there are some things which it sounds like they need remeasuring. So we've got the bonds, we've also got the brand, or intangible, and we've also got the deferred income. Of the 3, well, the brands are certainly easier, but I'll perhaps start with the bonds as it's printed first. So again, read again the paragraph if you need to about the bonds, and then we'll try and work out what to do. Now, these bonds, according to the scenario, were being measured using amortized cost. That's fine. We now need to bring them in at fair value effectively, don't we? So we need a fair value for those bonds, and then we need to post an adjustment. So in respect of the bonds, I need to work out what their fair value is. I also need to work out what their carrying amount is, and that would give me an adjustment. So hoover your way around the scenario and see what we know. We know that there are 6 million of these things, so I'm putting 6. It says the bonds with a similar risk profile had a value of $2. However, it indicates, doesn't it, that our bonds are less liquid, so we only want 70% of that. So the fair value of those bonds would therefore be 8.4. Now the carrying amount, that have been using amortized cost, they've only owned the bonds for 6 months, so we don't need to do a massive working. So in terms of the carrying amount, at the very start, they bought the bonds, didn't they, for 6 million. All that would have happened is that have earned interest at the effective rate for 6 months. So 6 million times, now the effective rate is 8%, times 1.08, but it's only for 6/12. Don't start thinking about compound interest or something in this exam. Please, keep it simple. So I think that's 6.24. That would give me an adjustment of 2.16. So be calm. The bonds need to increase in value by 2.16. So here we go. I'm going to increase the bonds by 2.16. The brand is much easier to deal with. In terms of the brand, again, look back at the scenario, all sorts of information about what it's worth to us, what it's worth to them. IFRS 13 says, particularly when you're thinking about things like fixed assets, what you need to do is you need to look for the highest and best use. It doesn't matter whether or not you're planning to sell it. What's the highest and best use? Remember, it's the price you would receive selling in an ordinary transaction, orderly market. Again, and surely the highest and best use there is it could be sold, I think, for 5 million, but the carrying amount at the moment is 4 million. So if it helps you to use a format like last time, you could. You probably don't need that this time. You could just write a sentence. But the fair value is 5. That's the price it could be sold to someone else for. The carrying amount is 4. And therefore, my adjustment is 1. It's maddening in the exam, isn't it? That the numbers often come out as very round sums, but because we often make little mistakes, we end up with numbers that are not round at all. There we are. There's the brand. Finally, we've got something on the liability side, this deferred income. So I'm going to abbreviate that on this debrief to DI. So in respect of the deferred income, we know a draft figure, which is 2.8 million. So remember, this is on the liability side of the balance sheet. This is revenue that we've not been allowed to take yet, or they haven't been allowed to take yet. Remember, with liabilities, how much, again, to transfer this liability? What would someone take it away from you for? And therefore, you need to use the information, and you're told, aren't you, that it would cost 1.7 to complete plus a markup. So conceptually, you could go to someone else and say, take this away from me. And then you'd have to give them 1.7 plus a 30% markup. So this time it's a liability. Once again, fair value, 1.7 times 130 over 100. Remember, that's how you do markups. That would be 2.21. The carrying amount of this liability is 2.8. Now, we'll think about it in just a minute. 2.21 less 2.8, that's 0.59. Again, you have to think the liability is going to get smaller. That's a good thing. So your net asset will go up. So smaller, the first two were assets getting bigger. The last one is liability getting smaller. So this one, when we post it, is another positive. So that's 0.59. After that, you don't need me to add things up for you. Again, we'll be able to finish the calculation. See how important IFRS 13 on fair values actually is. Now, if you need to, pause the recording before I talk about the last part of this question, which is the pension. So, pension, I've got a very clicky mouse. If you could hear a clicky noise, it just happens, doesn't it? So Part C is asking us to account for the pension schemes. It's accounting for the pensions. It says there are two types, a defined contribution and a defined benefit. And again, in terms of this, I think this was the other 10 marks in the question. And you're bound to go into a panic when you read this because it's got, there's a reference to the asset ceiling. Numbers are going everywhere. So it's a case, isn't it, of being calm. Now, everyone can account for a defined contribution plan. So do that first. The defined contribution plan is mentioned at the bottom of the scenario, where employees going forward will be in this plan, where all you promise to do is to put money into the scheme, and then when they get to 65 or 100 or whatever the age is, by the time you retire, then they'll see what's in the box, and they might be rich, they might be poor, but it's not the company's problem. There's a defined contribution plan. All that happens, of course, is that the pension expense is the same as the contributions. So the pension expense in the profit and loss is the same as the contributions, which were apparently $500,000. Finished. Defined contribution plan. Make sure in this exam you're always telling where the examiner where to put things. In this case, it's going in the P&L. Defined benefit plan. Panic sets in because of all of those numbers. So start by setting down some knowledge. Let's get some basic points down in terms of explanation first. They don't want a huge amount. If they want to know how pensions work, they'll ask an actuary. You're not an actuary unless you've turned up at the wrong exam hall, so you don't need to worry about that. But our job, isn't it, is to explain where things go in the financial statements. So my explanation would be to set out very clearly that in the profit and loss account, I will recognise, as you know, the service cost and the net interest cost. You might be able to say a bit more. Let's leave it at that for now. In the soft P, or the balance sheet, you know that you will recognise the pension assets, technically measured at fair value, and also the pension liabilities, a very complex actuarial calculation. And in OCI, you will recognise, remember the word now, remeasurement differences. And if a family member said to you, what's a remeasurement difference? I'd say, family member, a remeasurement difference is really there for unexpected changes. Well, I didn't think that would happen. You might also, even though you don't know how to apply it, you might also remember that there's a rule about the asset ceiling. And even though you're petrified about applying it, you might remember the rule. The asset ceiling rule says that basically, the net pension asset, it's very rare to have a net pension asset. Most of these schemes are nearly insolvent. They usually have a pension liability, net pension liability, but the net pension asset cannot exceed the asset ceiling. Again, if you know the definition of that, you could then expand it, but let's get the basics sorted out. So I must have got a couple of marks now for just explaining some basics. Now we all know that before the exam you have to rote learn the working which helps you to sort out the remeasurement difference. So let's start out with that and say, let's see what I can do from that. And then, if I've got that, I've probably got a couple more marks. So this is a standard working that will be in whatever course notes you're using, and you have to learn it. So all I'm doing is setting it up. I'm going to set it up on the left hand of my screen. Asset liability. And you can see as I talk through where my figures are coming from. I've got my brought down asset and liability, which were 260 and 200. I'm not worrying about the asset ceiling for now. I'm just trying to find the basic figures that I understand. I've got my service cost, and you know that service cost always increases the pension liability, and that's 30. I've also got my net interest cost, and as you know, whatever the interest rate is, you apply it to the opening asset and the opening liability. So 5% of 130 and 5% of 200. 5% of 130 is 13. 5% of 200 is 10. What else? I've got my contributions. That's the money, isn't it, that the company pays into the plan, and it increases the assets of the plan, and the contributions are 21. I've also got my benefits, and the benefits are paid out of the plan to the pensioners when they go to pick up their money every week. And the benefits, the assets go down by 25 and the liabilities go down by 25. Miss a couple of lines for now. I've also got the carried down figures for the asset and liability are 242 and 195. Now, it starts to get messy. But you can see if you were desperate, you could now just say, well, I can't do the rest, but I'll just balance this off and sort out the remeasurement difference as a balancing figure and carry on with my life and the exam. However, if you're able to deal with the curtailment, that's good. So let me just put the curtailment in now. Anything like a past service cost, a curtailment, anything that sounds like that, a termination, it always gets whacked through the P&L. And then just see what it says. It says the effect of curtailing, in other words, saying to employees, well, you're no longer in this scheme, we're chucking you out. The effect, again, I think, of the curtailment is it suggests, doesn't it, that the present, let me just see, I can see it on there somewhere, scheme curtailment 28, the liability will be reduced by 28 because of that curtailment. Now, in order to stop the staff going on strike, you have to give them some money, so they compensate the staff, and that's why there's a reference to the fact that the staff are paid off, and we give them 16. Why don't we give them 28? Well, that's human nature, isn't it? The employer doesn't really want to give them 28. The staff would quite like 16 because they can go out and buy some new furniture and a nice television today and worry about tomorrow. So that's what's happened. Assets have decreased by 16. I think that's easy to spot. The liability went down by 28. I think that's harder, and I think you might have been confused about that. If we stick with my figures at the moment, you could then work out a remeasurement difference as a balancing figure. And, if you gave up there, it's fine. But I'm going to take it a bit further. Just to show you how the asset ceiling works. Now, you can see if I net these two columns off, so we've gone now from the regular stuff, we're approaching the prize winner stuff now. If I have a look at the net asset, so if I just do everything in net asset terms, so 260 minus 200 is 60. And similarly, at the end of the year, 242 minus 195 is 47. You're told about the asset ceiling. It tells you the actuary has to work that out. So the actuary actually has worked out this asset ceiling. On the asset side, the asset ceiling, I think, at the start is 20. And at the end, I think the asset ceiling is 25. So that means that the opening and closing liability shows, opening and closing asset shown in the accounts will be restricted to 20 at the start of the year and 25 at the end. So if you were able to say that, it's fantastic. If you knew where the adjustment went, it's even more fantastic, because any adjustment in respect of the asset ceiling goes to OCI. So I'll just make a note up here. That may cause an adjustment in OCI. That adjustment in OCI, you need a brain the size of 500 watermelons to sort it out. And again, I don't think you would have time. But I'll show you, just very briefly, how on earth they've got there. So to do that, I'm just going to take this column out for now. And just say, okay, so what happens? Well, if I put a column on the right called final figures, if I put a column in here called adjustments, but really don't spend days and days on this. But if you can't do the working on the left of the page, you really are in trouble. You must learn the left-hand two columns. So what we're going to do is I'm going to reduce the opening net asset by 40 to 20. I'm going to reduce the closing net asset by 22. And that will take me down to 25. Now, those two figures, as I've said, will go in the soft P at the start and at the end of the year. Now, in the final figures, the service cost will just be exactly the same. So the service cost will be exactly the same figure as it was before, so there's no difference in respect of that. If you were to kind of add it across, the service cost increases the liability, which means it decreases the net asset. So in the printed solution, I think it will show up as a minus 30, and that figure goes to the P&L. Now, theoretically, if you have reduced the net asset from 60 to 20, that would require a corresponding decrease in the net interest cost. Because if you've reduced the net asset by 2/3, you reduce the net interest cost by 2/3 as well. And that's why you'll see a very mysterious adjustment in the model answer of 2. What is 2? 2 is 2/3 of 3. The net interest cost was 3, wasn't it? 13 minus 10. 2 minus 3. 2/3 of that would be 2. So again, should you go away and worry about it? No. So let me see if I can get this the right way round. That would give you a 1. We'll check my additions and stuff in a minute. That's going to go across into the P&L. The contribution, that will add across of 21. That's going to the cash flow. The benefits cancel out. Curtailment, I've already said, didn't I? That's going to the profit and loss. That's 12. And this final figure over here is the figure that will then actually go to OCI. It's the original remeasurement difference adjusted for the asset ceiling at the start, the asset ceiling at the end, and the change in the net interest cost. Now, are you going to get that right? Well, maybe you are, in which case you should probably be sitting where I am and I should be listening to you. I don't think we would we? Most of us, we'd say, well, that's too hard. But what we must focus on is getting the easy marks. So not to get the defined contribution plan would be silly. Not to write out the basic rules on the defined benefit plan would be silly as well. There we go. Have another look through that question, but hopefully it's started to show to some light again on what's happening. I'm just doing a little bit of adding up here because I may have got one of my brackets wrong. 20 minus 30 plus 1 plus 21 plus 12, 24 plus 1. Yeah, I think that's all the right way round. This and the OCI figure comes out as 1 in the printed answer. Good. There we are. Question 1 in the March-June exam 2021. Thanks.